I love that new market think tank wrapper. All the jerkiness fits with the Zoom meeting, the way that performance has been lately. Good morning, everybody. I am Bob Iaccino. We are here with another live episode of the Market Think Tank. We're going to be talking about live trade setups, what's going on in the markets, not like financial TV, where we talk about what has happened and what people think of it. Speaking of financial TV, I've got my buddy Jeff Kilburg, a regular on CNBC. He's a contributor there. He's also the president. You're also the founder of KKM, right, Jeff?
That's right, pal.
All right. Before we get started, talk a little bit about KKM because I want to make sure you get that out there. You guys do something pretty unique.
Well, thanks, Bobby. Fired up on this Monday to be joining you. And yes, KKM, we're headquartered here in Chicago. We're a boutique asset management firm. We work with a lot of financial advisors, a lot of high net worth individuals. We have an option overlay vertical. We also do a lot of ETF model portfolios powered by NASDAQ Dorsey Wright. And lastly, we do a lot of dynamic stock selections. So you talk about active and dynamic. That was the thing that worked in 2020. That's what we are, Bobby. We're active and dynamic, trying to be a value add to folks out here in Chicago, across the United States.
So we also do active stock selection, Jeff. So I want to start by asking you a quick question because obviously 2020 is a good year for us. It's a good year for you guys. What do you think the outlook for 2021 and 2022 is? You still think it's active? Obviously, there's years where active underperforms, right? That's just the monster. But what do you think is coming for 2021, 22 in terms of active versus passive?
I think you have to really understand what happened that last Q3, Q4 of 2020. What we saw in September, we really saw a lot of profit taking in information tech. We're seeing profit taking today in these FANG stocks. Look at Tesla, look at Apple down in the pre-market. But nonetheless, when we see this shift, this rotation being tilted towards the FANG stocks, that market cap weighted exposure, that really worked well for 2018, 2019, and most of 2020. But we're big believers. We have an essential 40 portfolio. We believe these essential stocks, these epicenter stocks, people are going to find the laggards. They're going to start finding love. And that's all about the rotation. You hear about the rotation on every TV channel, but I think it's real. You're seeing a rotation out of information tech, call it info tech. You're also seeing it go into small caps as well as some of these essential stocks. So that's where I think being active, perfect example, we retired a name Cisco, CSCO. That was out and Oracle is now in. So we're always trying to be active and dynamic in our essential 40. And I think at this moment in time, why we're different is that we're equal weighted. An equal weight strategy, as you know, Bobby, over a longer term. This is not a 1 year, 2 year, over a longer term horizon, like a 10-year timeline, that will always outperform a market cap weight strategy, no matter what the strategy is, equal weighted market cap weight. So that's where I think you have to be a little bit more thoughtful moving forward in 2021, not just your exposure, but your actual weighting, your target allocation. Where are you exposed and are you susceptible overweight to a Tesla, overweight to an Apple at this moment in time?
So let me ask you, I was going to go in a different direction, but I'm interested in that because we actually just sold Cisco as well. We did not add Oracle yet. Can you go into, without talking about anything that's proprietary, of course, can you go into the dynamics of Cisco versus Oracle, why you did that switch?
Well, so our essential theme, it's a really interesting portfolio where it has a quantitative component, also a qualitative component, but the undercurrent of this whole portfolio is essentiality. If you remember Peter Lynch back in the 1980s, Bobby, his whole portfolio was based upon buy what you know. This is buy what you use. This is buy what's critical to the American way of life and the U.S. economy, where Oracle checks all those criteria boxes. So Oracle just came into the portfolio, and that was interesting because Cisco, from a quantitative perspective, certainly was a laggard, but also from a qualitative perspective, I think it really fumbled. WebEx was one of the biggest systems out there, and they allowed Zoom to disrupt. So there's a couple moving parts to allow that switch, but Oracle continues to dominate in the cloud, and I think it's become more and more critical to the U.S. economy and the American way of life.
That's super interesting to me. We're actually on Zoom right now using
Yes,
Zoom.
sir.
Go. And also, I think we have Zoom earnings this week, if I'm not mistaken on that. So as I'm looking at the market right now, I'm looking at S&P futures are down about 70 right now. Russell is down about 62. The Dow's down about 0.5%. For those of you that don't understand when we talk in basis points, 100 basis points is 1%. I always want to make that clear. And that puts the NASDAQ down about 129 basis points. But you're not saying get out of tech. You're saying you should be in the right tech.
That's right. We talk about software. Palo Alto Networks is a cybersecurity name we really like, but it's interesting to see the tech component. There's a couple different slices inside of tech. So we believe we run a lot of ETF model portfolios. You know this, Bobby. We have our sector rotation, we have our tactical rotation. Tech is still very high on the matrix, but semiconductors is higher. Software is higher. So I think you have to be more considerate of your exposure. But what's really interesting, and you bring up a point, the S&P 500, last week on CNBC, I went on and talked about how I think we have a short-term pause up here. Melissa Lee kindly raised her eyebrow at me, but my trade that I presented was selling it at 39.25 with the stop 50 handles higher at 39.75 with a target 38.25. We're only about 50 handles away from my target. This is this back and fill. We talk a lot about, we used to talk about on the floor when we were allowed to be on the floor, Bobby. We talk a lot about this back and fill. So I see the market coming back here, but I think it's going to, again, be a buying opportunity. And one of the things we always talk to all our family office clients about is the buying opportunity. It's real, it's persistent, it's resilient. And why? It's because there's $5 trillion with the T. $5 trillion sitting in cash. So that's why all these pullbacks are shallow, as long as the Fed continues to articulate. And we're going to have some more Fed speak this week.
So let me ask you, there's a dynamic I think is going on. This is a thesis of mine where I think looking at where equities are versus where they were pre-pandemic, I see no way that the economy is better than where we were pre-pandemic. It's clearly worse. Restaurant employment down 43% in New York. Estimates through Yelp that there's going to be about 60% permanent closings in the service industry, sort of in general. So my question to you would be, is this enough stimulus to justify, whether it's 1.9 trillion coming, is this enough stimulus to justify where the markets have priced that in? Or do you think that back and fill you're talking about could be more extended post-stimulus, post 1.9 trillion, whatever else comes next?
I think it's enough and then some. And why am I saying that? Because the new administration, 1.9 stimulus, but they're talking about $3 trillion in this infrastructure deal. That's really significant. And I agree with you, Bob. There's a huge dislocation between the real economy and the stock market, but we're seeing some of these restaurants come back online. And speaking of restaurants, look at Cake, Cheesecake Factory. I know it has not had an up year since 2016, but CAKE is coming out of the gate a little bit stronger in 2020. If you're looking for a broader swath exposure, 2 restaurants coming back to life, maybe Darden is more your. I know you love the Olive Garden. I know you've hit that endless bucket of salad and breadsticks, but DRI, it's another opportunity. But I do agree with you. There is a dislocation, but my point is that the Fed is going to make sure that they continue to run this higher than usual, and they're going to be committed. Every time you hear Fed Chairman Powell, he's beating the dead horse. They're not mincing words by any means.
Anyone with Thai ancestry would be so sad to hear, as much as I was sad to hear you mentioned Olive Garden as an actual restaurant, that people of Thai descent would be sad to hear that I wanted to sell Cheesecake Factory when they dropped their pad Thai. That's my favorite pad Thai on the planet. And obviously I have no Thai culture knowledge at all because that was good stuff. But Mike Arnold, my partner in Stock Think Tank, wouldn't let me sell it just based on me not getting their pad Thai anymore. So what are you looking at? And again, this can be, you've mentioned a couple of names already, but what are you looking at in terms of names and or ETFs that you think are investable in the coming week?
So one of the things we talk a lot about at KKM is having active and dynamic exposure. But we also talk about having exposure to certain themes and sectors, but staying the heck away from certain themes and sectors. So if I give you our top 3 sectors right now, it's semiconductors, it's small caps, IWM, IJR, and it's also home construction, ITB. Now, home construction, it'll be interesting to see. We screen these technical portfolios every week. So it'll be interesting to see with the rates moving higher to 1.35, will that put a little bit of cooling on the housing? I say no, short term. Longer term, if we see sustained rates up here in the 10-year closer to 1.5%, that will be a significant headwind. But those are the top 3 sectors we're seeing. But what are the worst 3 sectors what we want to stay away from right now? Precious metals, specifically gold, we want to stay away from. Utilities, we want to stay away from. And lastly, you look at Cohen and Steers, they have a realty ETF. So real estate is really hard right now to get our arms around and grapple with, because the valuations, as we're going to see a lot of not bankruptcies, but a lot of different repricing, is that we're going to be in price discovery mode for the next couple of quarters on some of the real estate that we saw the carnage of the COVID-19 pandemic hit.
Just for the record, I agree with you on the housing short term. I think that the jump in rates that we've seen, it's the speed of the jump, not the ultimate level that's spooking the stock market. I think 1.39% on the 10-year overnight. We hit that. I think we're about 1.367 right now, somewhere in that range. But when you look at that, do you think that sends people to rush and buy the house they were looking at, thinking that rates might go higher?
100%. I go back to my Coach Holtz days, Bobby. what's important now. There's an acronym you had on the chalkboard all the time. It's WIN. So what's important now? If you were on the fence of buying something, you're racing to get pre-approved. You're racing to make that offer because you're scared about rates, and rightfully so. It just gets more and more expensive, and we're so used and so addicted to cheap money. But on the other side of the fence here, I don't think rates are sustainable of 1.5%. The Fed owns 1/3 of all the 10-year notes out there. They do not like the velocity. Last week, the 10-year note moved 28 basis points. No bueno, Bobby, no bueno. They do not like that movement. So they want to see a steady move higher and let it digest and see if the true economy and stocks can really absorb that. But I don't think they like any type of velocity in that type of move. And that was too fast last week for them.
You got Jerome Powell Tuesday and Wednesday. Obviously, speaking to Congress, who knows virtually nothing about anything. So do you think we get anything out of that, or is this just grandstanding again for the politicians?
I think it's a little bit of grandstanding, but I think he's going to continue to articulate his message, this dovish message that he's going to be here in perpetuity and unlimited capacity. He said that on March 23rd. That was the low in the marketplace just almost a year ago. He has not deviated from that position, Bobby. If anything, becomes more and more. And now you bring in Janet Yellen into the picture. I don't see the lack of commitment by any means on the horizon. So therefore, you may not agree with the market moving higher. It's not going to be a straight line moving higher, but the market's moving higher.
Let me ask you a last question before I let you go. In terms of the way that rates are moving, I looked at a chart earlier this week, and I wish I could put it up, but I can't because I forgot to send it to Jesus to put up. But inflation since 1996, basically non-existent for the most part. Jerome Powell has said himself, we haven't had inflation in 3 decades. But when I look at the actual separation of the different sectors, the things we actually buy, the things we actually need to buy have gone up. Electronics down, software down, TVs, cars flat. But when you look at things like childcare, healthcare, housing, food, actually there's a slight uptick in that. Do you think that matters for the equity market, or is it just the overall level?
I think it does matter for the real economy, but for the overall stock market, no, because the Fed, they do not utilize the proper metrics. They strip out food and energy. And then you talk about education continuing to uptick. There is real inflation, but the fact that they've not been able to produce inflation in the asset classes that they're particular to, that's where it gets different. And my buddy Iuorio, I know he's going to be on later, so please give him a forearm shiver. I know he talks about inflation, but I think that's the magic wand that the Fed wants you to talk about inflation, because we've been in a deflationary period for the last couple of years. So make sure you say hi to Iuorio and just give him a good punch to the chops for me.
Yeah, Jimmy's going to be happy that it took you 10 minutes to mention Coach Holtz. Jeff Kilburg, as the helmet shows him back, did play college football at Notre Dame under Lou Holtz. And Lou Holtz did say, watch market think tank. Bob Iaccino, say that, right? That's good. Jeff, thank you for being here. Really appreciate it. We're going to have you back if you're willing. Jeff gave you some good names. And now we're going to go to our sponsor, CME and E-Trade, where you can affect some of the trades that Jeff talked about. We'll be right back. Awesome.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We are back. We are back. Thanks for waiting. I'm really excited about this segment because I got my buddy Charlie Moon, who is the lead equity strategist at Prosper Trading. I'm starting to call this the Prosper segment. We have somebody from Prosper on every single show. I love you guys. I love your company. Love Scott. Love Mike. And you and I have been friends since we bumped into each other on a plane once, which I thought was interesting. Vegas, I don't remember even where we were coming back from.
New York.
New York, that's what it was. I was speaking there, and I think you had business to attend to as well. So anyway, before we get started, you actually head up the equity side of Prosper, right? There's the options guys, is Mike, Scott, everybody else, and you head up the equity side. I don't think a lot of people know you guys have an equities division.
Yeah. My primary focus is pretty much all of the above. I have a day trading room where we're working on these like penny pumpers, and then I have my large cap program where we're focusing on the more big boy names. Obviously tech has been weak, so we've been kind of shying away from tech, but we kind of want to give everybody a little touch of all of the above, the ability to kind of swing trade, position trade longer term, day trade if they wish. The market is really flush and really active, over the last year and a half. And it's just, the demand just continues to grow, and I love it.
So as we sit right now, we got the S&P, I'm just looking at my screen down here, down 72 basis points. NASDAQ is down the most. Let's talk about that in a second. The Russell's down 68, and the Dow's down 54. Again, if you're just joining us, basis points is how we talk. That's how professional traders talk. 100 basis points means 1%. And we've got the NASDAQ down 131 basis points, or 1.31% on the future side of things. Does this bother you, fourth day in a row for those three indices? I believe it's 3 of 4 for the Dow if it were to finish this way. Does this bother you, or do you just think we're overcooked and interest rates are starting to show a different direction here?
It's kind of all of the above. It's been a while, but it's very rare over the last few years that I've seen, what it seems like actual disinterest in names like Apple and Amazon and Tesla and Facebook. And, we see these, the hype that's just building up around the SPACs and all these high flying growth names. People made a killing in Palantir and JMIA and SPCE, and they just seem to continue to like try to rotate, rinse, wash, repeating those names. And it's like with Apple, it's just like a slow meltdown, slow rally. And it's very, it's not too often, especially in the last 18 months, where we just see this just total lack of low volume grinding movement in names like Apple and Tesla. Tesla in particular, the lack of disinterest, especially with the ties and the news to Cathie Woods and their introductory push into the crypto world with purchasing 1.5 billion in Bitcoin. And Tesla's just been a snoozer of all things. Just the talk of the town really is just like, is CCIV going to merger with Lucid? And that just seems to be the actual market right now. It's just the lack of disinterest. And that lack of disinterest is causing these stocks to pull back, which of course is waiting on, the Qs and the SPOOs. And then all of a sudden now the markets are just, more bearish than bullish. But people just don't really notice because they're focused on all these other hype names that have just exploded onto the scene over the last couple of weeks.
So you're pointing out, I think this is an incredible point, and correct me if I'm wrong, because if I am wrong that this is what you're pointing out, I'm going to take credit for this. People are barely noticing the sell-off, is what you're saying. I mean, is that why the VIX is finally breaking out today, even though we're 4 days lower? I just looking at the VIX right now, 2414. That's not even much of a breakout relative to recent breakouts. Is that what you're saying? Is it kind of going unnoticed?
Yeah, it just seems like even with big media, they just haven't really talked much about really, for me, it's like the struggles of a prominent name that have been very consistent in terms of, moving the markets, moving with the markets, whatever the case may be. There's just always some level of demand in these names on retracements, and these retracements are getting a little bit deeper, and the rallies are just not sustained. And so it just becomes this mode where they're just short-term pops. They're just left to kind of just melt off. Maybe people start buying in again, but it's not furious buying. And that's where there's a sharp difference. Like from last September, October, we saw furious buying in names like Tesla and Apple and Amazon. We saw furious buying throughout the summer in those names. And then December rolled around. We had Microsoft make a huge move, in off of earnings recently. And then it just seems like with Apple, Amazon, Tesla, especially Facebook. Facebook, is set to basically open at or just under their 200-day moving average. And for a company like Facebook to be underperforming their 200-day moving average, I mean, from a historical standpoint, it's just not too often over the last 5 years we've actually seen that without some major catalyst or black swan event that's causing that effect. And And so, this is telling me that either there's just a huge rotation on Wall Street into other sectors that have been moving very prominently, like energy, like transports, the vaccine opening names or the economy opening names. And, real estate is another one. And it just seems like they're just staying away, or they're just passively playing into these tech names. And I'm just not sure how that's going to weigh out for the market. I think this is where people could get really caught up because they just don't see that Apple's slowly moving down 1.5% here, almost on an intraday basis. And, everybody's just happy because they're making money in other aspects like SPACs. So it's just, I think this is where like the people may get caught, not sleeping at the wheel, but, they just may not see this, and then we correlate with everything that you just mentioned earlier. And it just may be just, that moment of the frothy rally is finally going to hit, reality. And then we just have to actually see a real correction, correction.
You sent us a couple of charts, so you obviously think there's still some opportunities out there. So I want to put up the first chart. Talk about this chart and tell us what you're seeing on here. It's going to be up on the screen in a second.
Yeah. So with me, this is an extremely, I don't know. It's not talked about enough, but it's widely watched in my room because it's a great momentum type name, and it ties to in my opinion, a very prominent sector that's going to really sustain and hold and perform very well over the next year and a half, based on the FOMC stance of keeping, obviously rates at that 0.25% level. So EXPI is known as a disruptor. And as we've seen this transition into a more tech-friendly situation and integration, and kind of really just like a evolution for tech-based real estate, Zillow Group, Redfin. We have a lot of news with Matterhorn coming out on SPAC. This is an actual disruptor. They're holding out a great moving average here, right around this like 71, 70.
Charlie, let me stop you because we've actually got, I still can't pronounce this company. What's the other chart?
Sorry, my fault. Aphria.
Yeah, Aphria. That's what we've got up on the screen. So let's talk about that one first.
Okay, so Aphria obviously is a big player in the cannabis industry. The hype around them, and it's almost like a slight arbitrage play, is the merger with Tilray. And of course, with the administration stance, a lot of people are excited about this sector. For me, it's like it's one of those names that have gone up too fast, too quickly, which is in some instances never, it's not a terrible thing for those that were holding low. But for those that are getting in late, I subscribe to the theory: what goes up fast comes down fast. Right. We saw it in GME. We've seen it in a lot of names. QS is another one. Nikola is another example. But I love Aphria more than Tilray just because the value for me is presented in two different ways. One, in terms of pricing, in terms of price movement and supportive behavior. The $20 level to around $19.50 is going to be extremely important for me. I would probably cut bait if it got below $18.50 on this position. I like to really enter somewhere between $20.50 to around $21.25. Now it's dependent on the overall markets. The markets rebound. This is going to be a big push. I really believe that if they crack through this like 22.5 level, they have a pretty strong run available in this name. There's a gap fill near that 26 quarter price level, and anything above that, we're looking into the 30s. The second portion of Aphria and the desire of Aphria over Tilray is that a kind of pseudo arbitrage on the merger play. When the merger was announced, Tilray and Aphria actually basically traded around the same price range. And so the discrepancy in pricing is where we may see some of that arbitrage come into play. You could get greater value by being a player in Aphria as opposed to Tilray, even though both will probably move in sync with each other in terms of stock price movement. So, Aphria has been basing here over the last few days. They've been a little bit less volatile, but when the markets or the sector has rallied, they've been one of the top 3, top 4 performers. So it's one of those, it's less riskier than Tilray. It moves almost on that same degree in terms of percentage and volatility. And I do believe that the sector is due for a bounce here. We'll have to wait and see, but if we start breaking above that 20.5 to 21 price level, I can start seeing zoom very quickly.
Before we go into Expedia, which is chart number 2, I just wanted to let everybody know that our sponsor E-Trade, there is a link in the description to open an account with E-Trade or move an account, and you can get a cash bonus. You can call a representative there and get that done. Let them know that we sent you, and you can buy APHA, that's Aphria, this cannabis stock. I'm really glad you sent us a cannabis stock because people ask us about them all the time and we simply don't look at them that much. But let's go to Expedia because we've got about 3 minutes left. I want to make sure you get your second potential trade in here.
Sorry, so not Expedia, EXPI.
EXPI, the charts.
Yeah, EXP World Holdings. They're a disruptor in the real estate industry. I like the advancements, especially from the technological standpoint of real estate. I believe this is going to be a very strong sector, high growth name, still some great upside. This is one of those names where you're either looking for a breakout very quickly above 73.5, or if it sustains at the 70.5, 71 level, that's basically a dip buy for a reversal up. Now, for me, the upside in this situation almost leads to almost a 4.25 to 1 reward to risk ratio. The risk parameters are a bit wide. Your stop's going to have to be just under 66, but that's just because of the volatile nature of the stock. It moves an average of almost $6 a day. So, having a 7-point stop, on a stock that moves $6 a day really isn't that wide. It's actually fairly tight. So I believe that they break out above 80. It's a pretty sure shot to 92. It's kind of one of those situations where you would look at it like lemonade. When lemonade gets going, the stock really gets going. EXPI is very similar. I love this momentum opportunity. Great short-term value, great long-term growth capabilities. This is something that's not that familiar to investors just yet, but I'm pretty sure, a year from now, people are going to look at EXPI and say, man, it's still early to the party here. They just did a recent split, a 2-for-1. So that's why they're priced at this price level. But this is one of the better performances of 2020, and it's something that a lot of people should keep an eye on, especially once it starts breaking above that 73 level. I think again, this could be a big mover here, Bob.
Yeah, we've actually been in EXPI before, and I was calling it Expedia then as well. So I don't know.
Keep calling it Expedia. Keeps going up.
It's just one of those things that confuses me. Charlie, Prosper Trading, where can people get a hold of you? You put out some good names. I appreciate that. So I want to make sure people know where to reach you if they'd like to.
Yeah, at our website, prospertrading.com, on Twitter at the Disciple of Trend. Come on and take a look. We give a lot of, free offers to people in the room if they want to come on and visit. You can message me at any time. I'm active on Twitter. I like to provide information, joke around, troll. Been talking a lot about crypto lately. What a maniac market. I love it.
All right, guys, check out Charlie Moon. Again, he's one of the lead equity strategists at Prosper. I am a subscriber to Prosper. I always like to put that out there so that people know I do get some option signals from them. But Charlie, thank you for being here. We're going to be right back with Mike Arnold, who is the co-portfolio manager of the Stock Think Tank, right after this word from E-Trade and CME. Stay with us.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Back, and I want to welcome in my partner in the Stock Think Tank, Mike Arnold. He's co-portfolio manager along with me, and he is also a chief technical strategist at Path Trading Partners. Does quite a bit on crypto on the Path Trading Partners YouTube channel. You should check that out because he literally puts up 2-3 videos a day, including some of the fast moving stocks. He did a great breakdown of what was happening with GameStop, I always call it GameStop, which was on the channel for a while, got a ton of attention for that. Mike, thanks for being here again. I want to jump in really quick and just give a little update on the market, because we're about to hit the cash open and we're still looking at the market being down right now. As cash opens, we've got the Dow down 55 basis points, the S&P down 70 basis points, the Russell down 68, and the NASDAQ down 126 or 1.26%. Mike, do you see anything technically in any of these indices that worries you right now, or is this a pullback to levels of support the way you see it?
Well, the S&P is pulling back right to the level of support and a concept we have called the rotation zone. It's trading right at the bottom of the daily rotation zone. I'm going to be watching today where it closes. My key level is 38.70. So that's my key level on the S&P futures. And I will get concerned though if that'll put me in neutral mode. If we get a close below about 38.45, I will start watching for an even bigger short-term pullback. The NASDAQ is a little more concerning. My key levels on that were about 13,500, and we are trading well below that right now, 13,386. But that's where I'm going to watch. Again, these things can snap back at any time, so I'm watching it on the closing basis. That's how we make our decisions. We will keep an eye on some key highs and lows, but everything we base whether it's our stock portfolio or what we do in the futures or even the cryptos, it's based off a closing basis.
So let me ask you, in terms of what's going on overall, you sent in a 10-year note chart, which I want to put up really quick because everybody maintains it. This is not some just all-knowing, shocking statement by me that stocks are moving lower because interest rates are moving up quickly. Not just the absolute level of interest rates, but they're moving fast. So if we can put up Mike's chart, talk to us about what you're seeing on this. This is a 10-year note futures chart?
Yes, 10-year note futures chart. That's a weekly chart.
All right, so
I'm really looking at things on the longer term basis with the 10-year notes. Now we have broken down below some key levels. I was really focused on the 136 area, and we broke down below that last week. We are now, though, very, very oversold. So I would not be surprised to see some kind of just reactionary rally. Reactionary rally on a daily basis. The first key level I would be watching is about the 135.30s. That would be a little short-term bounce, but longer term, I am definitely in bearish mode and we'll get into even more bearish mode. If we get a key close below about 134.30, then I could see a rather sharp longer-term pullback to the 132s. And that's my next major area of key support. We're actually in an area, we call this a clear path zone. We don't have a lot of major support where we're trading into down until we get to those 132s. So longer term, if we break down the key level we're watching now is the 25% pullback from the run up that started in October of 18. And that is that 134.30 area. So that's the key level we are watching that will trigger an even further cascade lower, which means rising rates again.
So if we get a little bit of a rally back, you think the way the current setup is, and obviously you don't do predictions, you just read the charts and say what they're saying. But if we get a pullback to, let's say, like 136 and change on this chart, we're talking about that's probably right around 125, 126 on the yield, which is kind of where the breakout was if you're looking at a yield chart. So on this futures chart, do you see it falling from there in theory? Because is there enough resistance?
Yeah, everything now is sell the rally mode. It's just waiting for it to hit the key levels and then roll over. So that's why, again, we're watching for a bounce. We're getting some technical little divergences running out of momentum to the downside right now. But then on any rally, once it gets to some of these key levels, it is longer term sell the rally mode.
All right. So I want to shift from that. and talk about the stock think tank, which you of course are the co-portfolio manager of. And the stock think tank has a core portfolio, and then it has what we call special plays. And this is obviously a signal service that's open to the public. You can go to the stock think tank, which there's a link in the description of this video to check it out. You can click on that link and check it out. And then I also want to mention the E-Trade link there. You can get a cash bonus from them if you open an account. But back to the portfolio, you've got about 5 holdings in that core portfolio right now, and then 1 special play. Can we talk about some of those core holdings? Specifically, I want to talk about Aflac, which you really like. You recently upped the price target. We have been in Aflac since January 7th, and it's been moving really well.
Yeah, and it went stagnant. We got in it, and it's just went stagnant for a long time, which tends to happen. It actually triggered a really nice buy setup, and then it went slightly up and then drifted sideways. Starting last week, it actually issued another buy. We were already in it. That's why I upped the price target. Our new price target is 49.70, which is a harmonic projection upwards. But this thing can really run if you look at the longer term chart on it. And we're just looking at it on my screen. If anybody wants to call it up on theirs, that would return it just below the longer term breakdown. So we had key support back in December of 19 and up through February of 20, right around the 49.70 to 50 mark. And so that's our target, because that was key support, and it will turn into resistance, and you will probably see some selling pressure there. So we will look to take off our position and then reassess it on a potential pullback.
So we've also got Canadian Pacific, Chase Corp, not Chase Bank. This is CCF, Healthcare Services, which is HCSG, and ADP in the core portfolio. Do any of those stand out to you as performing the way they should, or you just look at them all the same way? Once, we talked about Aflac stagnating right after we got in it. We certainly didn't get out of it.
No, just because it stagnates, a lot of times, it has to go quiet for a while before it really can build up some momentum. CP's been performing pretty well. It had a nice pullback into a higher time frame rotation zone, and we got what we call a double cross pattern. And it's just playing out today. It's pulling back slightly, but we're looking for a higher price above this most recent high of 379. CCF, you mentioned that, Chase Corp, doesn't trade as actively and can get some wild swings, but nothing concerning. We're in a fair amount lower than where it's trading now. The one that has become a slight concern to me is HCSG. They actually had decent earnings, sold off. They're trying to rally back. It's creating, though, a slight bearish pattern. So on this rally, depending on where it stalls out, we may look to exit it early. I'm monitoring that one closely. ADP had a really strong day last week. We just got in on this pullback. So that's just a new play that's come into the portfolio that I'm monitoring. Not surprised to see it pull back, because it had a couple very strong days on a potential breakout move. Longer term, I do like it. So our stop is a fair amount lower, and we're looking at least to about 176.25 as a first key target, and then a retest of the most recent highs.
So last year, and I want to talk about this for a specific reason, because I asked Jeff Kilburg the same question. Jeff Kilburg also does active investing, and you would call this active investing, right? I mean, it's not day trading by any stretch. Would you call it more active investing?
It's definitely active investing. It's,
so that's a fair term.
What we do, if people would like to know how we construct our portfolio, I do a fundamental scan. First of things, it's a modified value type scan. We don't jump into a lot of momentum stocks in our core portfolio. We may throw one into a special play at some point, but we're not big momentum players, at least in this portfolio. We tend to do things value based, which has been challenging. Then I do a technical scan. and we overlay that technical scan to find things in good technical setups. And finally, once we have some good technical setups, I do a final valuation scan to make sure things are not fundamentally strongly overvalued, because if they're fundamentally strongly overvalued and technically overvalued, then even though we might have a good technical setup, we do filter those out because they are overextended and possibly set up for a bigger pullback. And I'd rather get in after the bigger pullback. We don't need to chase things higher.
So
And it worked well.
I like this because this is active investing, but if you look at our last entry prior to the 19th, our last entry was on February 5th, and then no entries until Friday the 19th when we got an ADP, which is a little underwater now, but not much, about 80 cents, no big deal. Looking at from that perspective, what I've said, and in the Stock Think Tank, I do a weekly video update. And in the last video update, I believe, I have a bad memory lately, but I believe that I told people that when we have these periods where you're not getting signals from us, in the past, well, in the present too, it's because Mike isn't finding things that fit our criterion. And that generally has meant, not every time, not guaranteed, but it generally has meant that there's a pullback coming. That's what we've seen as of late. So in this particular, we're now working on our fourth down day for 3 of the 4 averages. It'll be 3 out of 4 for the Dow. In terms of coming to a situation where you have 4 days down like this, you're not bottom fishing, right? You're just waiting for things to kind of base and stabilize and set up.
Yeah, we'll watch for the pullbacks. I'll go through for example, with today, I'll start watching for the portfolio to see what's pulling back into some key technical areas. But then we don't just bottom fish. We wait for it to either get a bottom reversal signal or some kind of rotation back up off a key level, because we're not just going in to, especially in this market environment, when you can have some deeper pullbacks, especially even on earnings. A few companies even release good news. It's like sell the good news now. So we're just not trying to rush in and, oh, something pulled back, we got to scoop it up. We're waiting for it to prove itself again from a technical perspective, first and foremost.
On a leverage basis in 2020, the Stock Think Tank returned 62.79%. That's on regular Reg T margin leverage versus an unleveraged SPY at 26.2%. So even leverage versus leverage, this stock picking outperformed the S&P by quite a bit. Do you see that continuing, not necessarily from a perspective of the Stock Think Tank, but do you think that stock picking is going to continue to outperform in 2021? Because again, that's what this is. You look at the outperformance that the Stock Think Tank did last year, it's dramatic.
Yeah, I think it will continue. It's getting a little tougher to find things that are not overextended from a fundamental and a technical point of view. And about half of our scan list now is breaking down and going into it's getting actually undervalued from a fundamental aspect, but from a technical aspect, it's not performing well. So we may go through some periods where the portfolio is lighter. Like right now with our entry of ADP, I think we're about 70% allocated as of Friday, which is a decent allocation, especially since it's been harder to find some good stocks. But if we finally get at least a decent pullback and then some stabilization, it will turn into a good stock picking environment again.
Like, where can people find you? Before I let you go off on that, the link to the Stock Think Tank is in the description of this video. That's where you can actually get mine and Mike's picks. But where can people find you directly if they want to talk to you or interact with you or watch your videos?
One of the great places is to go to the YouTube channel, Path Trading Partners. I put up stuff regularly on that covering, and there'll definitely be a video going up today covering Bitcoin. Bitcoin's been going a little crazy this morning and last night. I actually put up a video yesterday covering that. They can reach out to us at pathtradingpartners.com or email us support@pathtradingpartners. They can follow us on Twitter at Path Trading. So those are the best ways to do it. One of the best ways, if you really want to get my attention, is just send support an email, and it will immediately get to me. I might not respond right away, but I will definitely see it.
All right, great. And again, to get our actual picks, the link is in the description, along with that link to open an E-Trade account. Mike, thank you. We're going to be back with my friend and all of your friend, Jimmy Iuorio, who also has his Futures Edge show coming up in a few days on Friday. So Mike, thank you. We'll be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We are back, and we're going to go to my buddy, the locally famous Jim Iuorio, who is also the host of PureXposure Media Group's new show, Futures Edge with Jim Iuorio. That will be Friday. I'm going to get the date right this time. Friday, February 26th, 3:30 Eastern. For the benefit of Jimmy, it's 2:30 Central Time. Jimmy, how are you? Talk about your show. Anything else, please?
So it's on a Friday. This Friday is going to be a gas. I don't know if you guys have heard of Bob Iaccino, is one of my guests, but the other guest is Carly Garner of DeCarly Trading. She's so much fun to talk to. She's so smart, and she simplifies things so well. She's the author of several books on trading and options, and she's really good in oil markets. She's a pleasure to talk to all the time. So that's 2:30 Friday the 26th. And the reason Bobby and I are joking about this, because we've got the date wrong like 4 different times. Friday the 26th, 2:30 Central, 3:30 Eastern.
Yeah, and I'm going to be on the show. Carly is restricted to giving trades because of her position as a principal in her firm, as well as being an analyst in futures and options. But I'm going to be on the show with her. And what I want to do with Carly is I want to listen to her analysis and construct a trade live on the show based on her analysis. Now, the futures will still be open. Futures markets will still be open at that point. I want to point out to people, it's really important to watch this show live. Otherwise, you can watch it over the weekend, and hopefully the trades we construct are still available for you on Monday. We tend to look at these things probably about a week to 2 week time frame, right, Jimmy? I mean, is that fair to say?
No doubt about it. That's when I try to trade minute to minute, I'm only, if I'm successful, it's mildly so. My trades I like to look at are options based and have about a 2 week time frame, which I'm about to tell you what I've just put on a couple minutes ago when we talk about it. But yeah, no doubt about it. Yeah, I mean, we definitely talk about swing trading and things like that too. But I don't know. I just think personally, it's hard for me to make money minute to minute.
So let me ask you a couple of quick questions. Well, first of all, Kilburg sent a forearm shiver, as he.
Oh, good. Yeah, good. He always wants to talk about football, and he always wants to talk about Notre Dame.
Well, here's the funny thing. We started the show 9 a.m. Eastern time with Kilburg, and it was 9:10 when he mentioned Coach Holtz. Oh,
so it took him 10 whole minutes? That's growth, man. That's growth.
Yeah, he's starting to become a person instead of just a Notre Damer. So I want to go right to your trade, and then I want to discuss what's going on in the market right now. The reason I want to go to your trade is the markets are open, the markets are moving, and your trade is a bullish one. It's a protected bullish one. I want to point that out. And because we're looking at markets that have opened up lower, we've still got the Dow down 42 basis points, the S&P down 52, the Russell down 41, and the NASDAQ down 112 or 1.12. Again, if you're just joining us now to watch Jimmy, basis points go in 100 basis points is 1%. So as I say, the Dow is down 42 basis points, it's 0.42%. So based on that, we're coming off the lows, and you just put on a little bit of a bullish trade in the NASDAQ. Tell us what that is.
Well, okay, you'll notice in the trade too, like I think it's difficult because there's going to be a 7 to 8% correction at some point. I'm not sure when, and I don't think today is it. But once we start to cascade a little lower like we have, and we did it relatively aggressively last night, it's hard to just step up and buy the futures. I mean, it can be a difficult thing. So I like these protected sort of trades. So I bought the NASDAQ mini, the 13750, 13850, 13950 call fly. So it's a regular with call fly. So the call fly, you're just buying a call spread and selling a call spread above it. That expires on March 5th, which is 2 weeks from today. I bought that for 8.5 ticks, which is $170 to make a potential 1830. Spoiler, you don't usually make a 10 to 1 on a call fly, even if things go great. I put this on because it's a risk mitigating trade. I think we're still in an upward trend. It's difficult to buy it when we've gotten so high and we've gone so high so fast. But my intention for this is, like, I bought it for 8.5 ticks. If within the first 2 days I can sell it for 11 or 12 ticks, I will. If it goes to next week and it's still knocking around, around the 8.5 level, I will expect more of it then, because then it will have a higher delta as things move higher and it goes through that bottom strike, that 13,750, which is about 2.5% above where the market is right now. And in the NASDAQ, as we know, 2.5% can be chewed up pretty quickly. So if the market rallied hard today and I could sell that thing today for, let's call it 10.5, 11 ticks, I would. Tomorrow for 12 ticks, I want a little bit more each day as the days go on. Does that make sense?
Yeah, that makes a ton of sense to me. Let me ask you though, I'm gonna throw kind of a 3-part question on you, because I know you're not afraid of those. Obviously, the market is moving higher because rates are moving higher, but not just the ultimate level of rates, the speed with which they're moving tends to spook markets. Can you talk about the relationship with tech and to a certain degree, the Russell and rising rates? And also, I was just out with Mike Arnold. He put up a 10-year note chart and he sees a short-term, I'm not going to call it a pullback, a short-term rally in 10-year futures potentially coming. He doesn't predict moves. He just follows the charts. So he says it could potentially come, which would put the yield back at about 125, which I then would sell the future at that point. So if you could talk about the relationship between tech and the Russell and yields and what that means, and do you agree with what's Mike seeing on the charts?
Well, you hit on something that I think is fascinating, is that the movement in the yield curve and long end rates going up, in my opinion, is blatantly signaling that there's an inflation worry out there. Think about this too. Rates are going higher, prices are falling, despite the fact that the Fed is buying $80 billion a month in those same securities, roughly. So today's move, the curve is steepened out today. Now, this is the point that I think is interesting. It's happened kind of fast. And I think that throws fear into other risk asset markets. And I think that's what the stock market is reflecting. I think if all of a sudden this move stabilized and if Mike's right, prices start to head a little higher and rates come back down a little bit to relax, I think just that relaxation will green light risk assets for sure. But what I think is about the NASDAQ is interesting. You mentioned NASDAQ and the Russell. The Russell's been outperforming wildly over the last probably about 3 months. And that's about moving from the stay-at-home big tech trade into the actual growth small names. And I had that trade on. I only recently took it off. And now I'm back a little bit more bullish than NASDAQ, mostly because it's been able to handle well a loss of some leadership. And they're not falling. The leadership is just kind of traded sideways a little bit, and it hasn't spooked the NASDAQ very much. So I think it has room for a bit of a pop higher. Did I answer all 3 of your questions? What I miss?
No, you did. I mean, you put your money where your mouth is with this call fly. And again, it's a very good risk reward trade. That's what I love about it. But in terms of, like, let's say the VIX, does it give you some comfort that the VIX it's had higher lows in 5 of the last 6 sessions, but it can't get out of its own way in terms of highs? It pops up there and then just kind of sells off. I mean, I'm looking at the VIX right now, up 6.3%, up at around 2346. It was up about 9.5, 10% right off the bell. And it just kind of pulls back. Does that give you some comfort in the trade idea?
Yeah, it does. There's a couple of things of the VIX that give me comfort. As it's starting to go lower from, historically was trading a long time at highs in the high 20s. As it's starting to go lower, I like that. Now, if it got to 12 and stayed there for too long, I would worry that the market wasn't pricing in risk effectively. Conversely, if it got to 60, I hate to quote Jeff Kilburg here, but I'm about to, because I like to pretend that I'm so much smarter than him. But I heard him say one time, a VIX at 60, he wants to buy the market, because to me, that's when we see panic. So it's a couple different, it's not just necessarily, in my opinion, directionally or level what looks good, it's how it got there. You know what I mean? So right now, the VIX moving from where it's stuck around 28, 29 for so long, and it's moving lower, that does make me feel pretty good.
Yeah, I don't want you to quote Kilburg either, because you brought up
I will never again. I swear on a stack of Notre Dame Bibles that I won't quote Kilburg again.
Olive Garden. I'm literally not speaking to him ever again.
Oh, yes. People who are not Italian may not understand the problem we have with Olive Garden, because we're talking about Italian restaurants versus Italian themed restaurants, and not even a very good one at that.
It's not. It's like Mario Kart being the way Italian.
Exactly, being Italians, right?
That's what it's like. So, in terms of the 10-year note yield, and we've got the yield curve in the steepest it's been in since 2014, and again, that happened rapidly. But in terms of the ultimate level, this shouldn't bother anybody, right? And in terms of like housing, do you think this spooks people to rush into housing? But I don't think the absolute yield is the problem. I think it's the speed.
No.
And NASDAQ companies tend to have more debt. Russell companies tend to have more debt. Individuals, obviously, tend to have more debt, although the pandemic's actually helped with that. The savings rate is going up. So do you think that the yield needs to move to, like, what level of the 10-year yield would bother you?
Well, in the next couple weeks, if it moved to, where were we last? Well, we were about 135-ish. Is that right?
We went to 139 overnight, and then we opened up the market about 135, 136.
That's what I thought. So, okay, if we all of a sudden spike to 1.5 in the face of the Fed buying, and I mentioned that again because I think it's wildly important. I think in the back of people's minds too, there's this consideration that if things start to get out of hand and the rates start moving too quickly, the Fed could obviously jump it up, and instead of buying 80 billion a month, they could buy 150 billion a month. They could do what they want to increase their balance sheet, all part of this modern monetary theory nonsense. But I think that right now where we're at, 135, between 140 and 120, I think if we can stay there a little bit, that's fine. That's still a relatively low rate. As far as you mentioned real estate, I think that real estate, like attractive real estate, Florida real estate, Texas, well, maybe not Texas after the weekend, but Florida real estate, and I do a lot of research just on different websites. I think there is a feeding frenzy. And I don't think it's because rates are going up. I think they're both signaling the same thing. I think long-term rates are going up and the curve is steepening because there's this inflation worry. And there's actually a little bit of a hyperinflation worry. I know we don't even like to talk about that, but even if it's gone from 0.001% chance of that happening to a 2 or 3% chance of that happening, that is extremely significant. So I think those things are signaling the same thing. I think there's a worry now that the dollar could crater. And I think as long as we mention the dollar, if it starts to head below 90 in the index, and again, the index is highly flawed because it's measured against the euro and the yen, which are both highly flawed currencies as well. If you measure the dollar against Bitcoin, it paints quite a different picture. I hope there was some value in that. I know I rambled a little bit.
No, there was. And you mentioned Florida real estate. So I think a lot of people know that I recently relocated from Chicago to Florida. And I just really bad timing in terms of the snow and cold you had there. I miss it so damn much. I can't even tell you how much I miss it.
It's been an awful winter.
Oh my God. But in terms of, so the real estate market, I think is an interesting thing. So I get emails from Zillow. Full disclosure, I'm renting one of my friend's houses down here. He's got a couple of houses and I'm renting one while we look around and see what we like and where we want to live. This is a permanent move, but this may not be the permanent place that I live in. So I get these emails from Zillow. When I first came down here, October, November, December, I was getting emails when the prices dropped. Now I'm getting emails that the prices are going up. Where actually this house has been on the market this long, price just went up 10,000, price just went up 12,000. Is that what you mean by feeding frenzy?
No doubt about it. And I'll even put a finer point on it too, is I've been looking, I'm a bit of a real estate investor. I have property in Colorado. I have some other place, whatever, but I've been looking for a place in Florida. And of the 15 places I was looking at 2 weeks ago, 13 of them are now pending. None of them were pending 2 weeks ago. This to me is an indication of a craziness, a fervor. And I use realtor.com and Zillow.com, and I literally spend, research, 45 to an hour a day. And things have changed, I think, drastically in the last week and a half. And I think, and I've said this a million times, that come April, there's going to be this confluence of events. The government stimulus is, potentially going to finally start hitting, the people are going to come outside. And I think essentially lockdowns are over in suburban Cook County. The restaurants were packed this weekend when it got to be 28 sunny. I can't imagine when it's going to be 60 and sunny at the end of March that people are going to come out. And the Fed and the government is not going to slow down in their trying to stimulate the economy. I think the risk now is to inflation and to the upside, and I think the property market is reflecting that.
Last question before I let you go. You're the only restaurant owner, Branson Palatine, that we had on the show today. My brother is a restaurant owner. I don't know if you know this. He has an Italian bakery deli up in Streamwood.
You told me that. It sounds awesome. Yeah.
It's fantastic. But in terms of being a restaurant owner, how much does the stimulus plan, including a $15 minimum, federal minimum wage, wouldn't necessarily affect you, but federal minimum wage, how bad would that be if that were somehow imposed on you? And I'm poisoning the well here. I'm assuming it's bad.
Sure, of course.
I talked to my brother and he says it's bad, but
no, there's no doubt.
Pay a high school kid to put cookies on a tray and he can't pay them $15 an hour. How would that affect you?
Oh, it's nonsense. And it's going to, in the restaurant industry, it's going to be blanket terrible. Certain restaurants that are in a position of strength, as competitors start to fall, get stronger. So I think it'll be okay for the really strong restaurants. But the whole thing is silly. Once they raise, and also too, restaurants are really good at going around this. So once they raise server rates to, tipped rates to $15 an hour, many restaurants aren't going to mind, because what they're going to do is pay them $20 an hour. This is what we would do. Pay them $20 an hour, say there's absolutely no tipping at all under penalty of being fired, and then charge an 18% surcharge that we will tell the customer goes to, paying key employees, whatever. And realistically, it can go to bottom line as well, because restaurants need, obviously, to make money or else they're going to go out of business. And our employees, by the way, want us to do the system that I just said. The last thing in the world our employees want is for us to go out of business and them not having a job. So the restaurant, most of the high-end restaurant workers understand how toxic and awful a national $15 policy is, including for tipped employees.
Jimmy, where can people find you if they want to find you?
At Twitter, it's at Jim Iuorio, which is JIMIUORIO. I put out a lot of stuff during the day, and I put out a lot of nonsense too. So hopefully you have a thick skin. At some point in time, I irritate just about everybody on Twitter, but there's market stuff too, if you guys like that.
And don't forget, on Friday, the 26th, 5 days from now, almost 4 days, the day's almost over for us. 5 days from now, Jim Iuorio, Futures Edge with Jim Iuorio. We're going to have Carly Garner on it, and I'm going to be on it as a guest. Jimmy's the host. It's Jimmy's show. Hopefully you watch that live as well, because you'll have about an hour or so to put on the trades we just talked about.
It's going to be fun. We promise.
Jimmy, thank you for being here. And thank you all for watching another episode of Market Think Tank with Bob Iaccino. Hope you enjoyed it. And remember, the replay is going to be up. Send it around, watch it. Please visit CME Group, who's one of our sponsors, and E-Trade. The link to open an account and get a cash bonus is in the description. Stock Think Tank link is in the description. Thank you all for being here. We'll see you next time.